Thank you all for your time. We're going to talk about legacy planning tactics today. And my suggestion is, of course, that it's a very important topic given the baby boomer generation and the great transfer of wealth that's going to take place over the next, whatever it is, 20 years. Also, I want to make a distinction between estate planning, who's going to get what, and then legacy planning, because legacy planning is just a step beyond estate planning in the sense that it's values based and it considers what's called social capital, meaning you might leave things to charity, for example, or an institution of, your choice, or the government. And you'll see when we go through things today that that whole legacy planning theme actually becomes quite self-evident. So I've created a solution called legacy planning, and I'm going to open the planning tactics window. And what I want you to notice is that I've applied the previous financial planning tactics that we worked with in the past. But this time, when I did, I also selected the estate uh, uh, choice on the slider. And this is important to appreciate because if you go to optimize excess cash, for example, what you'll see is that the line of credit is being paid off, but then all excess cash is actually going into the non-registered portfolio. Whereas in the past, when we've talked about wealth optimization, the excess cash has actually gone to RSPs and TFSAs. Um, but in this case, it's going into the non-reg portfolio because we're trying to preserve liquidity for estate planning purposes. And the same thing happens when you look at the portfolio withdrawals order. Again, in the past, if we look over here in the post-retirement period, what we used to see was non-registered portfolios on the top of the list. We'll draw from those first. We'll leave the RSP and TFSA so that they compound. But now that we're focused on the estate planning, we're going to draw from RSPs and TFSAs first in order, again, to maintain any liquid cash for estate planning purposes. When we look at the estate, we're really focused on the life expectancy year of the second to die. In this case, it's Sue. And we can see that the estate value is quite substantial, 14.7 million. The issue is that because they have assets, there are a lot of terminal expenses, terminal taxes. And so the residue for distribution is negative 2.3 million. And if we switch to today's dollars, you can see it's 2.4 million of estate value and 1.3 million of a negative residue. So that's fairly substantial. And that's, of course, causing an issue. How can we, what planning tactics can we use if we're focused on estate in order to minimize this residue for distribution? So just to kind of complete the picture for you so you can see why this is happening, I'm going to go to the solutions page and bring up the estate tab. And you can see for Sue that Bill Jr. is the sole beneficiary of all the assets, which includes some art, the cottage on which there'll be a significant capital gain, and the rental property that they have on which there'll be a significant capital gain, plus CCA recapture. So when we look at income taxes, we can see the taxes are 4.8 million. So the problem that we have is that liquid assets of the estate are 2.6. We've got significant taxes at death, probate fees, so that the total charges are quite large, meaning that the estate is underwater by, a fair amount. And again, if we look at terminal taxes, we can see it's capital gains on the rental property, the cottage, the art, and the rental income is just the income in the terminal year, but also all the CCA recapture is included in that. So let's go back then to planning tactics. And what we're going to do is we're going to create a new solution, which I've already done, and I've called it legacy planning tactics. So we started with legacy planning without any tactics applied. Now I've moved into the legacy planning tactics solution, again with estate selected. And you can see here essentially no change. But when we go down to the legacy planning tactics area, we'll start to apply different tactics. And the first thing we're going to do is look at donations. So donations really represent a values-based decision that the client has to make. We really want to keep the cottage in the family. We've got a large capital gain problem. What would happen if we donated art because it's less important to us than the cottage? So, and we could talk, of course, about selling rental properties and things, but that would still create, a taxable problem. So I'm going to select, and Bill owns the art, by the way. You can see that here. So Bill is leaving it under the will to Sue. So it's Sue who's actually going to donate the art. So we'll calculate the tactic effect. And what we see, and this is interesting, is we see a down red arrow, a large down red arrow, and a small up green arrow. And the reason for that is because the estate value goes down since, the art is being donated. It's not part of the estate being passed on to Bill Jr., but because of the tax savings through the donation, there is an increase in the residue for distribution. So what we'll do is, of course, we'll apply that. And then when we look at the output, we'll see the effect on the output. So, sorry, that was already included when we selected the art. So let's go on now and look at something else. And I'm going to show this to you a little bit later in a different way because I think it's actually quite fascinating. So what we'll do here is we're not going to select Bill transferring TFSA to cover any estate expenses. We want Bill's TFSA to transfer to Sue on his death in order to increase the TFSA that she has, which is going to increase then the effect of compounding on those TFSA assets. So we're going to select her checkbox, and then we're going to do a calculate. And what this is going to tell us is how much of the estate is required for to make the residue for distribute, or the negative residue for distribution. It's 2.7, and the available amount in the TFSA, which is 1.3, and therefore we're going to use all of that 1.3 for estate purposes. And what we can see then is that there's a decrease in the estate value. There's a slight increase in the estate value, but the residue for distribution improves by $1 million. The reason for the increase in the estate value is because, of course, there's an impact on income taxes. So this clearly has a very positive effect. So what we'll do next is we'll look at insurance policies, and you can see here there's an insurance policy for Bill. Right now it's going to Sue, which is fine. There's no issue on Bill's death. But I also have an insurance policy in Sue's name. And rather than leaving it to Bill or the contingent beneficiary Bill Jr., I'm going to select the insurance policy and say, leave some or all of it, software will figure out how much, to the estate, so that it increases the estate's liquidity for planning purposes, or for a liquidity residue for distribution purposes. Now, in this particular case, the policy is about $500,000. So when we apply that, what happens is that we can see the effect on the residue for distribution, which has now dropped to $900,000. And the cumulative impact of the three things we did has changed the estate value just slightly. You can see it here. It's actually gone up, which you'll find interesting. And we'll look at that in just a moment. But more importantly, what you'll see is that the residue for distribution has improved by 1.5 million. So when we started off, it was, let me just look, it was negative by $1.9 million, and now it's negative just by the 903. So what we want to do then is we want to go back and have a look at the estate output so we can see the obvious benefit. But when we look at the estate output, what you'll see, and this is why I mentioned this whole concept of legacy planning, social capital. What we'll do is we'll switch here to the legacy planning solution that did not apply anything. The amount that went to Bill Jr. was 14.7. The amount that's going to Bill Jr. is now higher at 14.735. And there's an amount going to charity, which is the art donation. And interestingly, what's going to the government drops from a little over 5 million to 4.8 million. So in fact, we're plus 35 million to Bill Jr., we're plus 301,000 to a charity. We can see that from an estate point of view, the government's getting less, charity's getting something, and Bill Jr. is actually getting more. And this is all part of that social capital concept. What I want to do now is just look at a few other things that are not included in the optimizations, simply because they're kind of different choices. So continuing with this whole idea of charitable giving, if Sue, for example, wanted to make a charitable bequest, a donation to a charity, what you would actually do is you would use lifestyle donations and the bequest entry, and that would create a charitable bequest on her death, which is a specific dollar amount that you can then enter. And it doesn't matter if you change life expectancies because you're experimenting. The charitable bequest will always shift so that it's her life expectancy year. One of the other things that might happen is if we go to the will tab, she might, for example, wish to donate a percentage of her estate. So the charitable bequest is actually a specific dollar amount she has in mind, whereas a percent allocation is whatever the residue of the estate is, donate a certain amount. So we could add here under contingent. Remember, her will says everything I have goes to Bill, but in the event that he predeceases me, let's look at the contingent. So in this particular case, we might make Bill Jr. 90% and say the charity gets 10%. The other thing that we need to look at is assets of specific specific assets that are not included in that charitable tactic. And these are things like beneficiaries for RSPs. In other words, instead of Bill or Bill Jr. Selecting the charity as being the beneficiary of an RSP. One of the things that I want to show you, because I think it's really interesting, so I'm going to switch to a solution that I set up, which is legacy planning, cottage going to Bill Jr. And if we go back to the planning tactics window, what you'll see is that we just have the regular planning tactics applied we don't have anything involved with donations and so on. But what I've done in this solution is I have made for Bill Jr. the beneficiary of his cottage. So remember that when I illustrate the importance of wills and the importance of being able to name a beneficiary, I talk about a second marriage, a blended family. Bill Jr. is Bill's son from a previous marriage. Sue's going to get everything. And then Bill looks at it and says, well, I have to leave something to Bill Jr. So Bill Jr. becomes the beneficiary then of his cottage. So in his former relationship, his previous wife ended up with the house. He ended up with the cottage. It's his asset. And he says, Sue, you get everything else. Bill Jr. has to get something. It's the Smith family cottage. I'll leave the cottage to him. Then Bill Jr. gets the cottage, but capital gains are realized, paid by Bill's estate. So if we go back now and have a look at the estate tab, what we see is that it's $500,000 underwater, and it's all because of the capital gain on the cottage. So whenever I've illustrated this in the past, I've always said the issue here, of course, is that we might need something like life insurance in order to provide liquidity for the estate, where the estate, by the way, is the beneficiary of the insurance policy. We might need to do that so that, you know, the estate has liquidity necessary to pay the terminal taxes. However, Bill might be uninsurable. This is a second marriage, blended family, he might be older. On the other hand, the cost of insurance, if he is insurable, given his age, could be quite substantial, impair the retirement lifestyle. So I've always talked about this is the issue, and one way to resolve that issue is leave the cottage to a spousal testamentary trust. And then the terms of the trust are, you know, Sue might have a use of it for a certain period, Bill Jr. for a certain period, and then Bill Jr. ultimately ends up with the cottage after Sue's death. When I was just playing with the planning tactics, one of the things that I more or less stumbled across, so if we go to income assets, you can see here that this negative amount in the bank account represents the negative value of Bill's estate as a result of taxes on his death. When I was playing around then with tactics and I was looking at the idea of the beneficiary of TFSAs, and I kind of stumbled on this, was that I selected the Bill's TFSA and talked in terms of it going to the estate. And what you can see is that the value of Bill's the amount required is $566,000, and the entire value, almost 500, is then going to the estate, providing it with liquidity to pay terminal taxes. And the important point here, of course, is money's coming out of the TFSA tax-free, which, by the way, means we don't have to buy an insurance policy, which would be with after-tax dollars, which would then reduce the retirement lifestyle. So you can see down here for Bill's estate that the negative residue drops from $582,000 to just $70,000. But interestingly, also because Sue doesn't have to come up with the money for the terminal taxes on Bill's death, that it's actually a beneficial tactic for Sue's overall long-term income assets. So if we go to, we'll apply the changes. So if we go to the estate output, we'll now see the significant difference that it makes. So again, we can see on the estate that what Sue gets and so on. And then I can compare that with the legacy planning tactics solution. You can see that there's quite a substantial difference in the negative residue, which is the key point that I wanted to make. So let's go down now to do reports. And what we want to do is we want to look at the what we can generate in the way of a report. So I want to remind you that one of the features when you're looking at the generation of reports is that in a report, there are comparisons, the one solution versus the other solution. So on the report tab, what we would want to do here is we would want to take the legacy planning solution where we did not apply any legacy planning tactics and compare that with the legacy planning tactics solution. I also want to remind you on the to-do list that we're not selecting any protection planning actions because that's really related to insurance. We want to focus on the estate. So under document actions, we're going to select anything that's related to the estate preparation, including things like powers of attorney. And if we want to add things, then all we need to do is select document actions, click add action, and then we could add anything we want, which would then show up on our to-do list. So under report, rather than doing a full report, everything included, one of the things that I suggested in an earlier meeting was that we actually have a more focused conversation on things that are very critical to people. And I think two focused conversations are legacy planning and then ultimately also protection planning. So yes, you can include the legacy planning output in a full report, or you can select sections that are pertinent to legacy planning. So the disclaimer, the introduction, the to-do list with just document actions, and then down here, the legacy planning tactics, and also under the appendix, just the legacy planning output. So I have selected those, and then what I did was I saved them as a legacy planning report. So when I want to focus just on producing output for legacy planning, all I have to do is click the load button, select the legacy planning report, and then I have the content that I want. And remember, the text can be edited by you so that you can replace our text with your text as a default, and then you can turn around and edit text on a client-by-client basis to personalize it. So let's click Print Preview, and we will just run through this focused legacy planning report. And one of the things that you're going to see is the estate distribution graphs and how they really emphasize this difference between estate planning and legacy planning, which includes that whole concept of social capital. So again, the wealthier people are, the more I think they tend to want to give something back, so to speak. And I'll just remind you again that the reason it takes some time to build a report is because whatever the applied tactics are, in the event we've made some change after we've done the planning tactics, then the software goes through one more time and makes sure that all the planning tactics are up to date. So as we go through, of course, the disclaimer, table of contents, little introduction overview, our to-do list, which is just focused on anything legacy related, a little intro, again, editable by you, and then, of course, the estate distribution graphs. So what we see here for Bill is the estate planning tactics for the base case, our legacy solution. And you can see that there's not much difference. There's a tiny difference between the value of what's going to Sue if we look down here under the legacy planning tactics solution. So this is the before and this is the after, and not much of a change. But here for Sue, which is where we did our legacy planning tactics, then we can see not much of a difference for Bill Jr. In fact, it's up a little bit. The government is getting less and charity is getting more. So there's quite a significant difference in that. And then we go through and we look at the impact of donations as a tactic. So again, the impact of donations is that the value of the estate is down, but the residue for distribution is up, again, because we've reduced income taxes. And then we look at individual assets to be donated. So we can see Sue is donating the art, and the effect of that is to reduce the residue of distribution, the negative residue of distribution. She's also bequeathing a donation, which I had entered, if you'll remember, when I showed you, you have to go to charities bequests for specific dollar amounts. So she's bequeathing that donation. And then we get into the TFSA to the estate and so on, and we see the value of the negative residue, and that the 1.3 is going to the estate, reducing the negative residue down to 960,000. And then we can get into things like life insurance, where again, it's a $500,000 policy, which reduced the residue down to 962. So this remaining residue is whatever table you look at is the effect of all of the different tactics that were applied. This gives you an estate summary, the before and after, and again, the net estate value that's involved. And that's for Bill, this is for Sue. And then we get into the terms of the wills as they exist now, and that's important to understand. So for Bill, his half of the house is going to Sue, but under the terms of the will, Sue's half of the house is going to Bill. It's down here when we look at the art going to Sue, then from Sue to charity, or the vehicle just being part of the estate asset, or the rental property, Sue's half going to Bill. So this is summarizing the terms of the will as it exists. Beneficiaries for any residue of the estate, they just go to each other, of course. And then you get into other things like, TFSAs and so on. This then summarizes the effect of applying the terms of the will. And what we can see when we go to Sue is that the percent allocation is being split between Bill and charity. There's a charitable bequest we looked at, and then the art's going to charity, the cottage to Bill Jr., the house, the rental property to Bill Jr., the RSP to Bill Jr. So this summarizes the effect of the estate planning or legacy planning tactics that we applied as compared with who's supposed to get what under the terms of the will. And then you can see the effect on the residue for distribution, and then we get into the forecasted estate value for Sue, also for Sue for Bill Jr. and charity. And then you can see the net worth summary of the estate for Bill and Sue over time, which is before taxes, after taxes, and so on. And then you can see here a graph that actually portrays that. And the net worth of the estate, you'll see, is running across the top. And that's because we have the assets, the life insurance that's applied to the estate. And then from that total, we subtract total taxes and estate adjustments. And estate adjustments are very simple. They're things like probate fees, funeral expenses, legal and accounting fees, that sort of thing. And then what you see here then is an estate comparison, legacy planning versus legacy planning tactics, and any difference in the estate, which out in time is more positive. And then finally, a legacy planning comparison. Bill, legacy planning tactics. Sue, legacy planning, no legacy planning applied, legacy planning tactics applied. So there's some pretty healthy output that clients can review to try and better understand, all the different implications of their estate. And that runs, however many pages. So that's what I wanted to cover today, gents. I'll thank you very much for your time, and I wish you a great weekend. Thank you.